Greetings. Today's Monday, April 28th, and last week the S&P 500 had a pretty strong week, rallying approximately 5.5% last week alone. However, since the low of April 7th, the S&P has rallied about 14, almost 15%. The market is opening up higher today as well. So while a 15% rally off of a low is pretty impressive, we're not yet convinced that we're truly out of the woods. In part, this is because of our proprietary risk gauge, the VSI. As you know, 14 different components go into that measurement. And right now, as of the end of last week, we have only 2 that have flipped back to a buy signal. So that tells us risk is still elevated. Now, in addition, this week may also be very pivotal because we are going to get the advanced estimate of first quarter GDP. On the screen right now, I've got the latest from the Atlanta Federal Reserve's GDP Now tool. You can see that as of April 17th, they were estimating negative 2.2. However, last week they updated that, so it is now negative 2.5 is what the Atlanta Federal Reserve is expecting for the first quarter GDP. That's going to translate into our histogram, as you can see here, which would be pretty negative start to the year. By historical standards, most people would define a recession as having 2 consecutive quarters of negative GDP. So if we're pretty confident we're going to get negative GDP in the first quarter, what's the second quarter going to look like? Well, now I'm looking at the Conference Board and their forecast, and you can see that they're forecasting positive GDP every quarter this year. Remains to be seen if the second quarter will be negative and if we'll see a recession. Now, while there's a lot of talk about the tariffs and what that has done to the economy, there's also some evidence to suggest the economy was already slowing before President Trump started this trade war. If you look on the screen right now, we've got housing starts, and in particular, I want you to notice that downward sloping trend. If we also look at building permits, which is obviously very closely correlated, you can again see the same negative trend. Job openings have also been in a pretty negative trend for quite some time, and in particular, what I want to highlight is the level that we're at right here is also going back to 2018. So there's already some evidence that the economy has been slowing. It just remains to be seen as to whether or not we're going to avoid a recession. One more thing I want to highlight for today is the money supply and inflation. As you know, for since 2020, we've been battling inflation. While some have argued that the inflation battle has won, I have been skeptical for quite some time. When we look at the money supply, the amount of money in circulation, that is the leading cause of inflation, and it has ticked back higher. If you look at the rate of change of that money supply, you can again see that trend, which is not welcome. Finally, we look at CPI, and CPI is the rate of inflation that you and I and the news media historically talk about. And you can see that last update, we have ticked back down below that 10-year average. However, the Federal Reserve's preferred measure of inflation is PCE, and last update, it actually ticked back higher. So I remain unconvinced that the inflation battle is over, and there's enough evidence to suggest the economy has been slowing. So you put that back in together with the stock market. The stock market is a leading indicator of what the economy is going to be experiencing. If this week can see the market move higher still, then I will have some more confidence that we are going to avoid a recession.